Good afternoon, grade 12. And today we'll be starting another topic, which is just a subtopic of investment. Remember, in our previous lessons, we did investment securities. We looked at different kind of investment businesses can invest in. And yeah, I'm on page 67 from the core note, page 13, and we'll be looking at investment insurance. So firstly, we need to look at what insurance is, and if you can still recall, insurance has been a topic we've done in grade 10, and we look at different type of insurance a business can do or take out, and we also look at the benefit of insurance to the business. So let's just quickly speak about the introduction of the topic. Businesses operate in a dynamic and in a risky environment. Insurance indemnifies. When you're talking about indemnifies, it means compensate businesses against certain types of risk they can find themselves. Business owners should have a clear understanding of the financial impact of accidents, disasters, or their business operations, so that they can make provision for that in advance. So what the introduction is trying to explain is that insurance is very, very important for the business, because number one, starting a business is a risk. No one is giving you the guarantee that you will be successful. Number two, the business have been exposed to different kind of issues and problems. And it's very important for businesses to actually have a plan. What if something happens to my business? What if there's a fire outbreak and every of my goods get burnt down? What happens if there's a flood? What happens if there's a natural disaster? Where do I start from? So it's very important for businesses to take out insurance on their goods or on the business. Insurance is extremely beneficial to businesses and individuals, as it provides a financial relief in terms of unforeseen financial losses. So, provide financial relief means that you will be compensated because you will have put aside certain amount of money with an insurance company that is going that which you can fall back on if anything happens to your business. So it provides a kind of a financial relief to the business in the times of unforeseen financial losses. And insurance plays a vital role in ensuring that businesses are sustainable in terms of being able to operate for a very long time. We will be looking at different kinds of information on that. We'll look at insurance and assurance, the difference between the two. So let me just quickly move on to the key concepts we will be talking about in the business. So we have a lot of content in here in terms of the concept. Let's look at what it means and the definition. What is insurance? It is a contract. Please underline that. It is a contract between a person or a business and insured, requiring insurance cover and the insurance company. So in a shorter version, insurance is a contract between the insured person and the insurance company bearing the financial risk. So which means the business, let me just use the word, the employer is the insured, and an insurance company is what we refer to as the insurer. For example, we have OUTsurance, we've got a lot of First for Women, and so on and so forth. So those are the examples of the insurer, and the business or individual is referred to as the insured. So when you're talking about insurance, it is a contract that is being drawn between the insured and the insurer in order to bear a financial risk if anything happens to the person or to the business. Then we have insurance contract. When you're talking about an insurance contract, it is an agreement, and I actually want you to put it in form of a written agreement whereby the insurer undertakes to indemnify the insured in the event of a specified loss in exchange for a premium. Let me just try and break that sentence into subsection. Insurance contract is an agreement. It is a written agreement whereby the insurer, which is an example of an insurance company, undertakes to indemnify, agrees to compensate the insured, which is the business or the individual, in the event of a specified loss in exchange for a premium. So when you're talking about an insurance contract, it is a written agreement that is being drawn between two people, the insured and the insurer, and at the same time the insurer, which is the insurance company, agrees to compensate the insured in case something happens, but the insured has to pay a premium for that. So the question a lot of learners do ask is that, Miss, where does insurance companies get the money to indemnify or to pay out? It is a premium that the insured has to pay, so that if anything happens, the insurer will be able to compensate you. Then we have the insurer. Who is the insurer? An insurance company that will take over specified risk, which means businesses and individuals are actually transferring their risk to the insurance company. Examples of insurance company, we have Avbob, we have Frost for Women, we've got quite a lot of insurance company which we see their advertisement on the TV. And we have the concept, the insured. Who is the insured? Individual or business that takes out insurance coverage. And we also look at indemnify. What does indemnify means? It means to compensate, to protect, or to repay the insured in the event of a loss or a damage. So which means, okay, let's take for example, I buy an expensive wristwatch, maybe worth of 10,000 Rand, which a lot of people do. Sometimes people have valuable assets, and I decide to take an insurance on that phone, on my wristwatch rather. Then I can go to an insurance company and say, okay, I need to insure my wristwatch because it's expensive. So the insurance company, for example, Frost for Women, would tell me, okay, ma'am, this is how much the value of your wristwatch is, and this is going to be your premium every month to protect that wristwatch, so that in case it's being stolen, in case it has a default or a problem, I can be compensated. Compensation in what sense? I will be given a financial compensation. Money will be given to me to get a new one. And at the same time, the money that is being given to me is actually coming from me in form of a premium to the insurance company. So in that sense, or in that case study or the scenario, it means I am the insured and Frost for Women is the insurer. Then we have a premium. A premium is the payment made by the insured. Example of the insured would be businesses and individuals to be covered in the event of losses or the damage. So we use the concept, we use the word premium is paid when you're talking about insurance. You don't talk about money is being paid. So please get used to those concepts: premium, indemnify, insurer, the insured. Then we have life insurance. What is life insurance? It is a long-term insurance that is taken out of life of a human being and cover for the loss of life. In case, when you're talking about a long-term insurance, it means only when that person dies. It is a long-term, and at the same time, it's being used to cover a human being in case there is loss of life. Then we have insurable interest. It is expressed in financial terms, and it is the interest that the insured stands to lose if there's losses or a damage. So when you're talking of insurable interest, it has to be in form of a financial. It is expressed in a financial term, and it's in the interest of something of worth, something of valuable, something that's worth it. In a situation whereby there is a damage, there is a loss, that person can be compensated. So we'll be talking about non-insurable interest. There are some things you cannot insure, even if you want to insure it. Insurance company do not see it as something that's worth it. Especially when you're talking of non-insurable interest, you'll be talking about things that are in fashion, things that are in technology, because things go out of fashion. And at the same time, technology grows every now and then. So there are some things you might want to insure. We refer, you think, okay, I need to insure this, but it's not being seen as something of value, something that are valuable, that's something that's worth it. And those are the things we refer to as what? A non-insurable interest. But when you're talking about insurable interest, you're talking about financial terms, and you're trying to actually protect something that is of good value from losses or a damage. Then we have unemployment insurance fund. We'll be talking about that. This is the fund provides benefits to workers who have been working and are now unemployed for reasons such as retrenchment. It is a compulsory insurance that needs to be carried out in the business. Then we'll be talking about the road accident fund, which is the RAF, and it is a fund that is used to compensate people that get injured or they get so disabled or death on the road. And we also have the COIDA, which is a compensation for occupational injuries and disease act, and it is the fund that protects employees that get injured during the course of work or in the workplace. So we'll be looking at those examples. So on page 70, let's look at the difference between insurance and assurance. When talking about insurance, it covers for a specified event that may happen. It may happen. There is no guarantee that it's going to happen. It may happen. So people take out insurance on property in case something happens. That is what we refer to as insurance. It means it may happen. There is no guarantee that it will happen. So example of insurance would be damage to the building due to fire. So it's not a guarantee that, okay, my shop will get burnt tomorrow. No, it's not a guarantee, but it may. That is what we refer to as insurance. And we have assurance. It covers a specified event that will. So that will happen means that it will definitely happen no matter what it may be. But the time of the event is what? Uncertain, but it will definitely happen. So for example, is a death of a partner. Definitely people will die, everyone will die, but the time is not guaranteed, or the time is not known, but it means that it will definitely happen. And even another example of assurance would be what we refer to as a retirement. Because obviously when you are 65, you know you're going to retire. So definitely we can classify retirement as an assurance at the same time. So those are the examples of insurance and assurance, and at the same time, the definition of insurance. Insurance is you taking out a cover for an event that may happen, and assurance is taking out a specified event that will definitely happen. Okay, let's now look at on page 71. Let's look at what we refer to as insurable risk and non-insurable risks. Remember, I was trying to explain that. What is an insurable risk? Businesses are compensated for losses arising from a specified risk. And when you're talking about insurable risk, it's something that when it's okay, it's insurable, it makes sense. It may happen. You get what I'm trying to say? It may happen, it can be predicted, and it's worth it. Let me use that word. So insurable risk is businesses are being compensated for losses arising from specified risk. What are the examples of insurable risk? Number one, fire. Okay, I'm protecting my business because of fire outbreak. It makes sense. Number two example is theft and burglary. It happens. Number 3 is storm damage during natural disaster, flood. It happens. Drought. Number 4 is doing, for example, is a life insurance. Okay, life insurance, it happens. Death. In the case of death, okay. Number 5, a vehicle insurance. Okay, anything can happen to my car. It can be stolen. It can break down. It can be fire, outbreak. It happens. And number 6 example is unemployment insurance. Anything can happen. People can lose their job at any time of the day. Businesses can close down. There can be retrenchment. Even without having retrenchment, look at what we are experiencing now. There's a lot of people that might lose their job due to this COVID virus, because businesses are not operating, businesses are at home, consumers are not patronizing, they're not buying, there's no buying and selling that is going on, and it's going to affect the profitability of the business. And at the same time, it can actually lead to retrenchment of employees. And you can see the government is actually saying those people that might not get paid at work needs to go and actually apply for their UIF so that they can be compensated, because now they don't have jobs. And now let's now look at the non-insurable risk. It's just the opposite of what we've spoken about. Non-insurable risk, these are risks that are not insured by insurance company. No matter what, no matter how much you want to pay for the premium, you can't get covered for that. And they remain the responsibility of the business. So businesses have to have a plan B on their own side to cover all this kind of risk in case it happens. Insurance companies do not cover all this kind of risk. Number 1, when there is losses caused by war, the insurance companies don't cover it. Remember, we spoke about Sudan. We spoke about a lot of countries that are having political instability. Businesses don't cover all those kind of losses that is being caused by war. Number 2, risk occurring in the period between placing orders and receiving goods. Okay, it's stolen. The delivery man didn't deliver to the business, and maybe he took it somewhere else, or it's been hijacked somewhere else. Insurance company do not cover that. The risk that occurs between the period that you place an order and the period whereby you receive the order will never be covered. Number 3, like I said, changes in fashion is an example of a non-insurable risk. Insurance companies don't insure all those kind of things, because changes in fashion comes along with a loss in value. When the new fashion comes, then the old one you have, the previous one you have becomes old. So the business do not cover changes in fashion. And at the same time, when there's shoplifting, businesses do not cover shoplifting. Insurance companies do not cover shoplifting. So they expect the business to have cameras and securities in place to check all those kind of losses. And also, losses caused by marketing malpractices is not being covered. Marketing malpractices in terms of all those deceptive advertising, advertisement, business needs to pay fine for that. No, businesses needs to pay their fine out of their own pockets, not requesting for indemnification from the insurance company. And lastly, advancement in technology, new machinery invention, that is changes in technology, like I've said, is not being covered by the insurance company, because it also falls within changes in fashion. Like it grows every day, new technology comes in place every day. So the insurance company do not cover anything that has to do with advancement of technology or new machinery invention. So let's now take a look at the importance or the advantages of insurance. What is the advantages of taking out insurance? It's very good to take out insurance on your business. Number 1, it transfers the risk from the business to the insurance company. So if anything happens to your business, you don't need to think like, where am I going to start from? The insurance company will be there to do what? To indemnify you and put you back at the right track. Number 2, it protects the business against theft, loss of stock, damages caused by natural disasters such as flood. So if a business experiences flood, they will be compensated afterward. There is a kind of protection. There is a plan B to fall back on. Number 3, the business will be compensated for insurable losses. Please underline that. The business will be compensated for insurable losses. Valuable business asset, for example, vehicles, equipment, needs to be insured against damage or a theft. It's very, very important. Businesses is protected against the loss of earnings, for example, during strike. Businesses are always protected, and from there, when you're talking of loss of earnings, businesses can be compensated. And even when there is damages and stuff in the business can also go for compensation if their asset or equipment is being damaged. And it protects the business against deeds of dishonesty by employees. Dishonesty by employees means stealing from the business. The businesses can be compensated from that. And also in terms of theft, the businesses can be compensated from that. Remember, I said theft, not shoplifting. So theft within the business, amongst the employees. The employees. And also, life insurance may be taken out against the life of partners in partnership in terms of a form of ownership, and it protects the business against losses due to the death of what? A debtor. So if someone is owing the business, there is what we refer to as a liability insurance that the business also carries out. Please add on, we call it liability insurance. The business takes that out. So in case a debtor, someone owing the business, dies, the business can get compensated for that. Yeah. And now stop on that subtopic, the advantages and disadvantages of principle of insurance, while I continue to look into the principles of insurance. Please, I actually want you to underline that principle of insurance is very, very important. I will talk about it in the next clip.